traders, welcome to the LFB and our global video charting review. This is for Tuesday the 22nd of February 2011. My name is Marco Haig from the LFB Trade Desk. Data, content and information is provided for us by the Automated Trading Program. Please read the disclaimer and disclosures that are posted to the LFB website, as Forex trading does involve substantial risk of loss and is not suitable for everybody. And please accept those terms before you take data from the videos. Global equity markets finally found the momentum to reverse some of the selling that had created near-term moves that saw European and US equities pushing through yearly highs recently. Asian markets pushed the Japanese Nikkei higher in 2011, while at the same time dropped values in emerging markets. The short signal on the Nikkei, the DAX and the S&P came in very quick fashion at the beginning of the week and did not allow too much time to make a decision on whether they would be easily able to hold. The Japanese Nikkei, which we can see here, found support at the 10,630 area. We can see that is the 20-day simple moving average, and it's also a 38% Fibonacci retracement area of the long moves that started at the beginning of February. Adding to the short-sided pressure this week was news of a downgrade of Japan's AAA rating in reaction to the potential inability to easily rein in public spending. Traders will have to wait patiently for a new signal on Nikkei equity trade, because as we've seen over the course of February, sporadic price action that houses most of the price movement in the pre or after market. The German DAX spent all of February in an upwards move that offered very little opportunity for those looking to be on the short side of European stocks, having moved from 70.50 on the 28th of January up to test this 74.50 area on the 18th of February. We've seen a 38% Fibonacci retracement just being completed. The sell signal was hard to incorporate into trade. It happened fast on Friday and needed the momentum of futures market trade to add to the cash markets banking of yearly profits. This short signal came hard and fast ahead of a US bank holiday as well. However, now may not be the time to be looking to get short the German DAX, because this could be the start of a three-wave ABC down structure, with the A wave looking to have been completed, the B wave, so now we're looking at A to B. This is the one that we're waiting patiently on, that would then create a B to C leg. Now, the interesting part of this, on an ABC down structure, whatever the length of that A leg is, so we can see we've dropped from 74.50 to 72.50, there's 200 points. If the German DAX holds around this 38% retracement area, it's very, very likely that that same 200 points would be seen from then 73.50 down to 71.50. Wave counting is very subjective, and the most difficult wave to identify is the first A and then AB structure. If this B leg gets up and touches the 61%, the likelihood is the length of that 200 pips, that will be the maximum you could then get. This will be a very strong retracement higher. So as long as the German DAX stays around this 73.50, it's likely that we're going to get 200 pips of downwards movement. From a technical perspective, if the global market gets an economic or fundamental reason to push stocks lower again. But now's not the time at this point to be looking to get long or short this German DAX. You really need to see Tuesday trade complete. S&P 500 trade has seen sporadic price action in February, with most sustainable moves coming in the futures market rather than in Wall Street cash trade. This is a typical first quarter trading pattern when earnings season has been positive overall. The move from 12.65 at the end of January up to test this 13.40 on the 18th of February has now seen a 23% retracement that finds support around the 13.25 area. Recent trading history on S&P 500 futures reveals that tests of support and those reversals to support have been shallow and have lacked momentum. Equity trade looks to be in a phase where any dips are being bought in line with long momentum coming from high frequency trading algorithms, which are well supported by the Federal Reserve Bank of New York and their primary dealer auctions. In general, global equity markets are holding the higher ground in developed areas. However, it does have to be noted that emerging market equity trade is negative for the year, while at the same time US and European markets are deep in the green, as is the Japanese market. Patience will be key whilst equity markets search for a signal as to whether the recent dip will be bought or whether this is the start of a period of distribution that finally banks profit generated from the 1st of January. The global commodity markets have had a very similar look and feel to that of 2011 equity trade that have been very well supported as global precious metal markets drive gold and silver higher, backed by massive speculative interest coming into oil trade. These three markets have reflected the importance of diversification in a balanced portfolio and become incredibly important as a standalone asset class that will battle the manipulation being seen in US dollar valuations. The long sit on gold that came on the 14th of February that broke higher from 1365 has completed its upside cycle. A test of support at 1390 on bullion is now in place, and traders will wait for confirmation that the recent dip from 1410 down towards 1390 will be bought in trade on Tuesday. It needs to be noted that a near-term cycle of trade should be witnessed before new long positions are instigated and before February profits are banked too early. A new signal will not be seen on gold bullion at least until Wednesday, when traders have been able to absorb near-term price action and to see global market reactions to breaking news headlines. Silver bullion traders have seen an extremely bullish asset class develop over the course of 2011, with potentially more upside in percentage gains than could be expected out of the gold bullion market. The long silver signal from the 17th of February, which we could see developing and posted out 16th and 17th newsletters, has now been completed. It's completed the upward cycle. No new signals are going to be issued until the recent price action has been confirmed as being able to hold support, which it does look as though it's doing at 32.50. The move lower from 34.50 to 32.50 there looks to be a natural reversal that banks a part of February's profit without, however, instigating a clear signal for any kind of continuation in this silver market at the moment. We do have a very strong long trend. It does look as though the dips are being bought, and this is a very solid test of that recent move higher that completed an upward cycle without generating a short signal. West Texas Intermediate, which is the most liquid of all global oil contracts, heavily, and we mean heavily as we can see here, reversed the recent short trend that had held WTI prices in a $3 channel between 87 and 84, which we can see at the bottom of the screen. And that was an explosive move higher on the 18th of February that added over 10% in value in 2 trading sessions, including a huge gap at the get-go. The fact that the moves higher on WTI have been fundamentally based will now require those same fundamentals to remain intact if $100 a barrel is to be seen anytime soon. It should be noted that global market expansion and growth are not the reason for the dramatic moves higher in oil trade, and therefore as quickly as the headlines appeared is as quickly as West Texas Intermediate oil trade could be seeing $87 a barrel again. In general, a period of consolidation is now going to be in place on Tuesday, and traders will be well advised to hold existing positions rather than looking for new opportunities in global commodity markets. As this week unfolds, a very clear picture will form in regard to fair value on global commodity trade, and signals will be emailed out to clients as they hit. The dollar index has been on a roller coaster ride on Tuesday, having absorbed a Monday session of trade that was dominated by futures markets due to the President's Day holiday in the US. An explosive move higher from a test of support at 77.50, which is the same price point that now forms a quadruple bottom that's seen moves higher over the course of the last 5 months, created momentum that added 1.5% to the dollar index values overnight. However, the failure of European cash market trade to drop equities lower and the ability for US futures market trade to hold S&P 500 equity contracts above 1320 reversed the moves in the dollar index ahead of Tuesday Wall Street trade. These are unique trading times with unique economic environments and unique central banking outlooks that are pitting one region against another in regard to currency valuation and fair value. The Federal Reserve is not alone in wanting to manipulate its currency, but does stand alone as the instigator of explosive moves higher in equity and commodity trade that have not as yet been matched by the same percentage drop in the dollar index. This index has got 10% more to go lower until it gets to parity in regard to where equity markets are at this point in time. Overseas holders of US debt are not going to allow the Federal Reserve to easily crush the value of the greenback and are trying to negate Fed-induced commodity inflation, which increases the value of regional exporting currencies for those countries that are battling the Fed that's trying to get the dollar lower. These are pivotal times in regard to economic and social outlooks, both of which will have as much to do in finding fair value on global currencies as the quantitative easing program does by the Federal Reserve. The globalization of markets seen over the course of the last 5 years is now at an inflection point that really does look to be setting new values in regard to the US dollar. And that highlights the need for something other than just the greenback as the global reserve currency. And maybe we could read gold, silver, and oil. In general, traders will be well advised to bank early and bank often when using currency trade in line with days that risk is being bought, because one soundbite headline has the ability to heavily leave all markets floundering at this point in time. It would be wise to watch the complete Tuesday session of global trade that absorbs Wall Street's first trading session of the week before decisions are made as to where the dollar and the major currencies will be able to trade going into the beginning of March. One thing that's perfectly clear, however, is the global market's desire to hold the dollar index above 77 support.